Okay, and here we are. Good morning. It's Genesis. This is Mike Williams. Long-time viewers will recognize this screen setup in that I've tried to lay out here the same setup we had for the last couple of videos. The far side of your screen to the left is the Dow Jones ETF, the diamonds as it's referred to. The middle screen, follow my cursor, is the spiders for the S&P 500. And the far right screen is the Qs, which denote the NASDAQ 100. Now, as longtime readers and viewers know, the typical perception is that the Qs are more volatile. Obviously, they're recognizable as the tech bubble, but the Qs have the growthier side of the market in their index. The S&P 500 is called the broader market, and of course the Dow is the 30 industrials. Now here's what's interesting. We've had our first, if you would call it corrective action. It isn't that significant percentage-wise, but we've had our first red ink of any significance for 2014. It happened for a series of days just following January 23rd. As you can see, it rapidly unfolded in a fairly steep manner. And it rebounded, as you'll note in each of the charts, they have this band. We had referenced it in past videos as the likely trade range that would be retested for support. And as you can see, the purple lines were drawn all the way back to their breakouts in the October period after a relatively lengthy May to October trade range. Remember, in May of last year, everybody thought there'd be another regular summer swoon that had happened for the previous several summers, and of course the sell in May and go away rule had picked up in its intensity. And then it didn't work for a lot of those years, but particularly in the summer of 13 last year, there was almost no corrective action. There was one period of 5 days, and then it rallied right back, but stayed pretty much in a trade range. Broke out, as you can see here, in October in all of the cases. So typically breakouts are retested as support zones. That's fairly normal. And one that we had kept reiterating in our morning notes. Of course, it has unfolded. We don't particularly think it's all over. Of course, the very frustrating part would be that it is, and that markets are already ready to jaunt back to the races. We certainly hope, as we have written many times, that is not the case. We further hope there is a bit more frustration ahead. And while you're thinking we're completely nuts, we hope that because a new secular bull market arriving will give us very few times to buy great deals again in future years. And it's always good to have everybody terrified after a breakout. So here's what's happened. In a period of roughly 10 trading sessions, the market set itself back by about 6%. Strangely enough, though, if you look at the makeup and structure of this corrective little wave here, notice that this is the Dow. These are the bigger stocks, the quote-unquote safer stocks. This is the broader market average, and this is the risky stuff. Okay? And just follow my cursor because I'm going from left to right. Excuse me, let me get some water here. What I think is kind of interesting is that if it was Armageddon again, and if the world was coming to an end, and if all those things we had to worry about in Greece and all that stuff has simply been replaced by 4 or 5 other small countries, and that's going to be called the new contagion, as the news has spread rapidly that Peru's currency is in trouble, and Argentina's is in trouble, and Brazil's is in trouble. By the way, they have a notorious record of having significant numbers of currency problems in those particular countries. But here's my point. Look at this corrective wave as a percentage of itself and its structure. It came well back. In fact, it dipped under this trade range. Then look at the spiders as a percentage of itself, and you'll notice it came right back to the trade range. And then notice the Qs, the perceived more aggressive ones, and they barely got back to their trade range. Now let's look at the bounce. The bounce here has gotten almost halfway back. The Dow, of course, the safe ones, my gosh, it hasn't even gotten a third back. And then the ugly old aggressive ones, the ones that talk better about the future, well, they're over 2/3 back. So here's the thing. You got to think of this in sort of multiple dimensions here. If the world was ending, the safer, bigger household name stocks would have done better than the ugly old aggressive things that are way too dangerous. And I'm sort of being a little bit sarcastic, but you get my point. And then, of course, the broader market has kind of ended up in the middle, if you'll notice. I find that an interesting viewpoint, in that it hints that what money is really saying is that the growth side of the market is still the healthiest, and that it is the one that is implying where the real growth is going to be. Hence, things are getting better and not worse. Things are getting more productive, not less so. Benefits are rising, not falling. And corporate structures in America are far healthier than the news of the last few weeks might lead you to believe. So note that each one of these indices during this little shellacking here had their volume rise quickly. They came up to that number. If you've noticed in your previous charts, I've drawn a line across high volume days, because that's usually where the emotion runs the highest. The higher the volume, the more gritty the emotion, history has taught us. So all of them reached the points that one would say, okay, we're going to get a little bit of a bounce. Of course, the bears are going to say it's a dead cat bounce, and the bulls are going to say, oh gosh, did I miss the correction? We would like to hope that if you could extend this out a few months, all of these charts, we would like to hope that this range might compel the markets to stick close to this trade range. These two purple bars on each of these charts is a range from the previous breakout. I'd love it if I could pick my choice, would be to spend, I don't know, a couple months just trading back and forth right above or within this trade range. That would just wear people down. I find it interesting that last week, right before this 3-day bounce, this is the S&Ps, last week, all the data came out from the week before of mutual fund inflows and outflows. And what I found fascinating is, in an ugly 1-week period, we set a record amount of outflows in a week from the masses using mutual funds as their investment. They sold ETFs, they sold domestic, they sold international, they sold emerging markets, and they sold mutual funds. They sold them all. But they sold them at such a pace that they set records of selling. And yet what's interesting here is this price right here was scaring them last week, but it was heralded in back in the middle of October as a new all-time high. Follow me on that. This price and this price are the same thing. One had never been seen before and was, oh my gosh, great, we're at a record all-time new high. And one is simply retesting the same area. Yet here they were excited, here they wanted nothing to do with stocks. Now, laugh if you will, but that's what emotions do to people. It's proven by the data, repeatedly for years and for decades. It always works the same. It tells us that right under the surface, right under that veneer of, oh wow, I feel great, is, oh my God, here it comes again. And all you have to do is just scratch a little bit on that surface, and that bullishness immediately turns into fear. Now, I have to tell you, in my 31 years of helping people understand markets and move along their wealth building path, I have to admit to have never seen the emotion so tight and so close to the surface that it immediately ignites on any what would normally be perceived as normal price action. Now, normal turns into panicky looking because everybody heads to the door at the same time. There is no patience left anymore for setbacks. There's no tolerance of normal red ink. There's no tolerance of, hey, markets are supposed to sell off sometimes. They don't go straight up. And God help us that we should thank God that it doesn't go straight up, because we never get a chance to buy opportunity. So this is a good thing, strangely enough, a very good thing. It's positive that we are struggling with fear in such a mild overall setback. I'm going to lengthen this out a little bit for you so you can see what I mean. I'm going to go to a weekly chart. Look at this. Forget all the words there because that's over the... But look, that was the correction up here. Way up here. And people are petrified. Let's see if it looks any different on the Qs. Any more magnificent. Here's the Qs. Let's shrink that in to cover, I don't know, as many years as we can. Look at that. Okay, that's 09. And that 2-week period is what terrified everybody again. That little spot up here. Look at that. Let's put a little highlight mark around that. Let's draw in a rectangle so you can kind of see vividly how that looks. Look at that. Fill color. Let's do white. And let's do the weight. There you go. That's it. Now, what? They're afraid here, but they didn't like things down here? I mean, seriously. I realize this seems rather strange, but that's what the data is. Over and over again. So let's think of it this way. You want the market to correct and chop around a bit. We don't want this thing to run away from us again. We don't want this thing to just turn right around and that really is it. Granted, it could be it. We might spend a couple days just shopping around here. It'll take off again. No one knows the future, but what you would prefer to see happen is for this market to stay around this trade range for a while, to come back in maybe 2 or 3 times, just chop back and forth, back and forth. Why do we want that to happen? Because I promise you that my bet would be if you spend another month or 2 in this chop and you get that intense feeling to emerge again in the crowd's mind, they will in fact be terrified of this market. They will pull their money out and a new wall of worry will be created. The wall of worry is the fear process that slowly induces the market to a higher level. What happens at a higher level? Fear goes away. What happens after fear goes away? We get to buy opportunity on the next correction. So let's make sure we look for that. Talk soon.